Good afternoon, everyone. Thank you for waiting. Sorry about the slight delay there. We had some technical issues on our end. Thanks for joining our webinar today. In light of International Women's Day this weekend, we'll be covering the important topic of women and wealth and the challenges and opportunities we face when planning and investing. My name's Lily. I work on the advisory team here at Netwealth, and today I'm joined by our COO, Rachel Willocks. In this session today, we'll cover some important general topics on the sandwich generation, the great wealth transfer, male and female investment behaviours, and where the wealth management industry typically falls short for female clients. We'll then cover the ways Netwealth can help and how we've addressed some of these points to empower our female client base with investing and financial planning. So thank you to everyone who sent their questions in ahead of the session today. Done our best to address these in the content, but if you do have any questions during or after the session, then please do contact advice@netwealth.com, and one of our advisors will be very happy to organise a one-to-one to discuss your personal and tailored needs, as well as the ways that Netwealth can help in more detail. So first, Rachel, I thought we could start with the sandwich generation. What is it for those who may not know whether they fall into this category or not, and why is it important?
Yes, thanks, Lily. Yes, very happy to be here. The sandwich generation is a term used to describe those midlife adults who are caring for both their aging parents while still bringing up their own children and managing their own careers. Women often take on the bulk of these caring responsibilities, and therefore it's particularly pertinent when we are talking about women and wealth to consider this cohort of women. There are, I would say, a number of challenges faced by those in the sandwich generation. These can be directly financial in terms of providing financial support to parents as well as their own dependents, or the time spent caring for others unpaid can mean career breaks, which may impact on their own financial goals, and particularly the ability to save into pensions to support their retirement. And overall, people in this situation are often time poor and therefore have little spare capacity to worry about their own finances.
Thanks, Rachel. Would you mind sharing some of your experience on being part of that generation and some of the challenges that people may face?
Yes, I would say I am part of the sandwich generation. I obviously have a quite busy and demanding job as the Chief Operating Officer of Netwealth, and I'm also the single mother of a 15-year-old boy. I'm pretty used to this struggle now, although it does constantly evolve as the parenting needs of your child change. However, add to the mix that my parents are now in their late 70s, and my father was diagnosed with Alzheimer's a couple of years ago. And so I now find that I'm taking on additional responsibilities in helping them. One of the first noticeable impacts of Alzheimer's for my father was after a career as a chartered accountant and finance director, his sudden lack of ability and interest in managing his own finances. So as a result, after putting in place a lasting power of attorney, I'm now responsible for his tax returns, thinking about my parents' assets and how best to invest these, taking into account those future care costs that we will have to pay for, and also to help educate my mum, who was never previously involved at all in managing their money.
Yeah, it's tough, and presumably Netwealth and your experience working in finance more generally sort of helped you manage that as well.
Yeah, absolutely. I mean, I'd say it's difficult enough coping with those changing dynamics within familial relationships, but I'm obviously fortunate enough to work here where we manage people's money. I understand about pensions and income tax, capital gains tax, and I have access to our financial planning tools. And therefore, it feels a little less daunting managing their money. I know that my sister wouldn't have a clue where to start and is certainly very thankful that I'm able to take care of this for our family. And I'm sure.
Yeah, so sort of by nature of your role and your experience in the sector, Netwealth sort of inadvertently helps you. But if your sister was an only child, for example, we have some solutions on this slide, how Netwealth would typically help. So if you're under financial strain and pressure by supporting your family, perhaps longer than you anticipated, we can offer financial planning to help navigate through and create a structured plan in how much you can afford to be giving, whilst importantly meeting your own needs first. Typically, we might see the sandwich generation delaying their own financial goals and retirement. And Netwealth can help with this through financial planning, guidance from advisors, and investment management of your pension and ISAs, so helping them grow to their fullest. And we have some useful modelling tools that Rachel mentioned that can account for things like healthcare costs, and importantly, if you're short on time, balancing children and elderly parents. We have on-hand advisors and very responsive client service teams that are hopefully able to do the heavy lifting for you with things like transfers and payments, so you don't need that added worry or burden. So even if you don't have a knowledge in finance, like Rachel, by proxy of your job, hopefully Netwealth can help. And I think, Rachel, if you could talk a little bit more about the Netwealth network now and how that works a bit more. I think we may be struggling to hear you. I'm not sure if that's on my end. It's not a problem. We can wait for Rachel to. Oh, I think you might be back.
Is that working?
Yes, yeah, perfect.
Slightly, yeah, sorry about that. Yes, don't forget, we also have the Netwealth network. This allows a client to invite up to 9 other family members or friends into their network. And what we do is then we consider the aggregate contributions of the members of the network in order to determine their fee rate. The benefit of this for the sandwich generation is by inviting parents into that network, they can potentially benefit from a lower fee rate, which will help their retirement savings last longer. And on the other end, young adult children, when they leave home and eventually start working, can be encouraged to start saving, as they can join at a lower minimum of just £5,000.
Yeah, thanks, Rachel. So moving away from the sandwich generation for a second to another topic that we wanted to touch on. There's been a lot of talk over the years of the great wealth transfer. So I was wondering, Rachel, if you could talk about this and some of the opportunities this might open up.
Yeah, there's the great wealth transfer and the gender wealth gap and investment gap. These are both very interesting. The great wealth transfer is the expectation that over the next decade, $100 trillion of global wealth will be transferred to millennials and younger generations. And what we expect is that this will put more money into the hands of women globally. In fact, today, women control approximately a third of all money globally. And with the great wealth transfer, this is set to rise to a half, which is obviously good news for women and should help close the gender wealth gap that we have seen historically. But then there is still this question of the gender investment gap and why women are less likely to invest in the stock market and hold more of their wealth in cash.
Yeah, in 2024, that UK investment gap between genders, as you can see on the slide here, is 567 billion. So the same size as the entire GDP of Poland, which is quite an astonishing number. And research shows that 6.8 million women invest compared with 9.9 million men, and that men on average have 35% more in their pension pots by the time they retire.
Yeah, I mean, I think women often think about money in different ways. We have different needs and concerns, and our expectations about how we want to be looked after in wealth management are often different to our male counterparts. But also we live longer on average than men, and therefore our wealth needs to last longer.
Yeah.
But in fact, although 9 out of 10 women will need to manage their own finances during their lifetimes, and 40 to 50% of marriages end in divorce nowadays, a large proportion of women still defer to their spouse on money decisions, perhaps lack confidence in this area. And even after divorce, they often may not want to address this. I was speaking to a friend recently who said that the last time she had to sort of properly delve into her finances was during her divorce. So that now feels like an uncomfortable thing to do, and something she avoids.
Yeah, and I think that leads really nicely into the different investment behaviors that we see in men and women. And I've brought some up on this slide here.
Yeah.
So different attitudes and behaviors when investing that we can see in that differing engagement levels and that gender wealth gap. And largely, a lot of the gender wealth gap can be addressed by accounting for the different investment behaviors between men and women and tailoring the wealth management space to meet women's investment needs more. So firstly, on that slide there, we have risk tolerance. Women stereotypically likely to be more risk averse than men, picking a lower risk option for your pensions and ISAs or holding too much in cash. This can be particularly detrimental to your overall financial plan if you do have some time on your side to invest, and can explain the lower balances we see at the point of retirement for men and women. Obviously, there's earning power and career breaks in that, but taking the right risk adjusted returns for the investment time horizon you have is important, and holding too much cash can have its dangers too. And that's something I'll touch on in a bit more detail later, in how our advisors at Netwealth can help with this. But next on there, we have investment time horizon. Women are typically more long term focused and patient with buy and hold strategies, as opposed to men, which can actually lead to better investment outcomes. It's just about getting women invested in the first place. Women also live longer, as Rachel mentioned, and this needs to be taken into consideration when investing and planning for the future. Next there, we have confidence. And that's a big one, and one that we can change the most easily ourselves through engagement and education, hopefully like this session today. Women have less confidence in financial decisions, even when they don't actually lack the knowledge compared to their male counterpart. And so we'll seek more information and advice, which generally is a good thing, but we shouldn't allow this lack of confidence to paralyze us from making financial decisions, even if we feel we lack the necessary expertise. And this is something that our advisors are on hand to help with, taking you through your options and answering your questions. Stock markets, the wealth management, it's a traditionally male dominated space, but it doesn't need to be. And we want to help provide you with the tools and the information to manage your investments and meet your financial goals. Moving on the slide there, different investment goals. So women prioritize financial security, stability, planning for family needs like children's education or retirement, and finally, social and ethical considerations. This is an investment area typically women are more interested in, and prioritize more than men in their investment decisions. And at Netwealth, we do offer an SRI, so socially responsible investing portfolios alongside our core portfolios to hopefully meet those needs. So often in the wealth management space, we see the industry fall short for women, and typically a lack of female advisors and representation there, a lack of personalization to the unique circumstances women face, like career breaks, and a focus on super high net wealth clients. So Rachel, perhaps now you could talk a bit more about how Netwealth focuses on those gaps in the industry.
Yeah, I mean, yeah, as research actually shows that obviously women can have equal financial knowledge and confidence levels as men, and that women, in fact, who have female financial advisors, invest up to 11% more than women with male advisors. Female investors are therefore obviously not incapable of being good investors or resistant to good quality investment advice. However, as Lily, as you've mentioned, too many avoid investing altogether or not investing enough to secure a strong financial future. Our CEO, Charlotte Ransom, is convinced that one reason women do tend to hold so much in cash is because they find it harder to engage with the personal finance industry. And she argues that setting those tangible long-term goals, such as a target income to aim for in retirement, is a much more powerful motivator for women than being pushed to buy a particular product. She often says that, once women understand how their investments can line up against their goals, they generally show themselves to be very savvy investors. And really at Netwealth, we're very proud of the fact that we've built a business that works as well for women as it does for men. And that's both from a client perspective and for our staff. And, on International Women's Day, it feels only right to celebrate this. So we just wanted to sort of highlight that, at Netwealth, approximately 40% of all our employees are female. Within our female advisory team, 50% of our advisors are female, 50% of our client service team is female. We obviously have a female COO, but we have a female CEO, Charlotte, and founder. And also 3 out of 7 of our board members are female. You can see them pictured on the slide here.
Yeah,
And
and I
yeah,
definitely think that that's contributed to that last fact there of sort of
mm,
46% of the clients being female, which is much higher than the industry standard. I'm going to spend a little bit more time now specifically on how Netwealth can help you get started, our approach to investing and financial planning, and why investing is important. So how we empower clients. So firstly, getting invested in the first place is important. The stock market can feel intimidating and cash can feel like a much safer bet. And whilst having a cash buffer is an important part of every financial plan, holding too much cash can be detrimental to your overall outcomes, particularly over the medium to long term. If you have a goal that you need to meet, for example, money for a house deposit in, let's say, 2 years or less, then cash with interest rates where they are is a good option. However, over the medium and long term, inflation will erode the real value of that cash, as shown by the graph here. And I'm sure we've all found that the interest rate that you could lock in 1 year, 2 years ago was much higher than what you can lock in now. And with the Bank of England predicted to continue reducing rates in the near future, the power of investing really comes back to the fore. So on this slide here, we have £100,000 either invested as cash in the dark blue line or the Netwealth risk level 4, so a more balanced portfolio in that lighter blue line. Now, after accounting for inflation, you can see that the better outcome in preserving the value of that £100,000 is when it's invested rather than held as cash, where that £100,000 is now worth £66,000 due to the impact of inflation. But the period we've picked to show here is interesting as well. As you can see from the x-axis, we start this graph in 2007, right before the global financial crisis. So you can see over on the left-hand side, when the stock market crashed, you would have perhaps been better off in cash. But as the stock market rebounds, which it always does, from 2009 onwards to the end of 2024, you're better off having been invested even throughout a turbulent period for markets in the global financial crisis. So hopefully this slide helps illustrate the dangers of holding too much cash, as well as the benefits of investing over the medium and long term. So as intimidating as it may feel, the benefits, getting some of that cash working for you, investing, really results in the best outcomes. So investing is important, and helping clients make this transition from cash to being invested is something that the advisors here at Netwealth can help with. So once you're then invested at Netwealth, we like to talk about controlling the controllables for the best outcomes to your financial plan. I'm going to talk through that in a bit more detail now. So on this slide here, on the left-hand side, we can see all of the things that are out of our control when we're investing. Those are market returns. We cannot predict or control whether the market is going to go up or down. Then we have inflation. Can't control what level of inflation we see in the global economy, but as shown on the previous slide, it can really be of detriment to your financial outcomes. And finally, their longevity. We hope that we live long and happy and healthy lives, but we can't control how long we will live for, and so our invested assets and retirement pots may need to last longer than we think. We can't control these things, but we can account for them in our modelling, and I'll touch on this more later. But instead, let's now focus on what we can control. So I'm going to bring up the next slide here. On this slide, Instead, we're focusing on the right-hand side for the best outcomes when investing, focusing on what we can control. We can control spending time in the market and being invested in the first place. We can control how diversified our portfolios are. And again, I'll touch on how Netwealth helps clients achieve this with our own portfolios later. We can control tax wrapper optimization, so looking at ISAs, pensions, junior ISAs. And again, our advisors at Netwealth are always on hand for prospective and existing clients to discuss this and ensure your understanding of the allowances and rules. It can very much seem complicated. Changes in legislation from different governments can change the goalposts and rules a bit as well. And finally, their fees. Fees are a really big one, as we can control how much we pay for the investment management or financial planning services. And being with a provider that is a lower cost without a compromise on the service is integral. And that's very much where Netwealth positions itself. And I'll go into more detail on our fees later. But now I'm going to touch a little bit more on how important each of these controllables are and how to think about them to meet your financial goals. Firstly, I mentioned time in the market rather than market timing. So getting that cash invested and trying to stay put is going to lead to better outcomes. Give me a second here. Staying put, stock market can be volatile, as shown by the returns on this slide here. We've got the S&P 500 index, which encapsulates the return of large American companies. And on this chart here, you can see, despite the dips and bouts and sharp moves up and down, from the 1980s until 2024, that general trend over time is upwards. So remaining invested over time throughout inevitable market volatility to participate in the upward trend is important, instead of jumping out of the market when we experience volatility and then jumping back in when the dust seems to have settled. That's known as market timing, and it can be costly and extremely hard to do, as markets are always forward pricing. So by the time you may have recognized that it's calmed down and seemingly a good time to get back in, you're likely to have already missed the returns as the markets have factored this in already. And the graph here shows just how costly timing the market can be. So if we look at the total returns of the S&P 500 since 1987, it's over 5,000%. But if you miss just 10 of the top trading days in this whole period, your returns are not even half of that, at just over 2,000. So less than half of the returns from missing only 10 of the top days in a 37-year period. And we never truly know or can easily predict when these top days, or indeed the bottom days, will come. So picking the right risk-adjusted returns to meet your goals is paramount, and why at Netwealth we advocate for spending time in the market rather than trying to time the market, climb that wall of worry and participate in that general trend upwards over time, trying not to sweat the volatility that you may see along the way. But that being said, different people are comfortable with different levels of volatility in their portfolios. And if you have a shorter term goal, it may not make sense to take maximum levels of risk. The right amount of risk is going to depend on your goal, your time horizon, and also how comfortable you are with volatility, so your willingness to take risk. And you can see here, typically with longer time horizons, you can afford to take more risk, but medium or shorter term horizons are better suited to lower risk levels. So looking at this graph here, if you've got a 1 year or less time horizon and you were invested in either the Netwealth risk level 2, so low risk, risk level 4, balanced, or risk level 7, high risk, all of those, there's a relatively high percentage chance that you might lose money over that time frame, whether low, medium, or high risk, if you're invested for that short length of time. There's an increased risk of loss, which is why I mentioned earlier the shorter term goals over shorter time frames, investing may not make sense, and we recognize that, but it does make sense for more medium and long-term goals. So if we move to 5 years, for example, when looking at data from the last 30 years, there wouldn't have been a time you received negative returns from investing in our risk level 2 or risk level 4 portfolios over 5 years. So there may be good portfolios to look at to achieve your 5-year goal, but risk level 7 due to its high equity content and the volatility we can typically see with this risk level, may not be suited to helping you meet your goal over 5 years. Moving further along here, all the way to the 10-year time horizon on the right-hand side, you can see that if you're invested for 10 years out of the last 30 at risk level 2, 4, or 7, you would not have lost money. So high risk and volatile portfolios may not be well placed to help you meet your goals in the shorter term and are better associated with those longer term horizons. So this chart hopefully demonstrates the importance of your time horizon when choosing which level of risk to take to help you meet your goals. And this is something our advisors at Netwealth help clients and prospective clients with all the time, thinking about your time horizon for your goal and also your comfortability with risk and volatility to help you choose the right risk level and help you achieve your objectives. So now I think it makes sense. We can skip the slide here, to look at our risk level portfolios in a bit more detail, since I mentioned risk level 2, 4 and 7 on the other side. But how do we build these portfolios? So our investment approach at Netwealth is coined active management with passive implementation, and I'm going to explain further what that means. So our portfolios are very much actively managed by the team here, looking at strategic allocations, adding in cyclical positions in direct response to market events, policy or data to either add some downside protection on our portfolios or capture some performance on the upside. So this is all very active and done by the team here. It's what you're paying the fee for, to outsource the portfolio construction and market analysis on an ongoing basis. So that side of things is active, but how we select the instruments for our portfolios is through passive funds, namely ETFs or index funds, so exchange traded funds. Now this is a deliberate choice by the portfolio management team. We have the freedom to invest in the entire stock and fund universe, but when looking at past data and covering different geographies over different time horizons, passive funds tend to outperform active funds because active funds levy high fees, and it's that net of fee return that matters in your portfolios. We're also not trying to be stock pickers and choose the next Tesla before it becomes Tesla. It's notoriously hard to do and leaves you open to the concentration risk of a single company and that company's fundamentals. Instead, we are invested in thousands of companies in different sectors, different regions, and different currencies, because this diversification is something that we can control and something that helps our portfolios. Now, how does that level of diversification look in practice across our 7 risk level portfolios? You can see that on this slide. So if we look at the top chart, we've got the asset allocation of our 7 different risk levels, 1 being lowest risk, 7 being highest risk. And you can see the different colors represent different asset classes. So fixed income or equities or alternatives, but the different shade of the same color represents further diversification. So all the shades of green are the different regions of equity market exposure we have. So we diversify through the UK, US, Europe, Asia, and emerging markets. And the different shades of yellow and orange, for example, is our alternatives, so gold and commodities. Then on the layer below, you can see our currency exposure across the 7 risk levels. So more currency exposure, the higher up the risk levels you go, adding a further layer of diversification to the portfolios. As it's discretionary management, you don't need to worry about the level of allocation to the Japanese yen or why it makes sense to be invested in China A shares. This is what you're paying the fee for the team here to do for you. And it's also worth mentioning at this point that this is showing our core GBP allocations. And we, as I mentioned earlier, we also have GBP SRI, so the socially responsible investing portfolios. And we'd be very happy to share the asset allocation or performance information for these portfolios if that is of interest. So please do email us afterwards if you'd like to see that. But now I'm going to explain a bit more why diversification is so important in portfolios and why it's one of the things you can control and the Netwealth helps clients to control. This slide shows the importance of that diversification in action. Here we have the biggest intra-year drawdown in equity markets in the dark blue. so how much they fell in a given point in the year, versus the return that fixed income, so another asset class in the grey bars, gave over that same period. Fixed income or bonds and equity markets are typically negatively correlated. So when equity markets are doing poorly in times of market stress, as shown by the drops in the blue bars, fixed income tends to give positive returns, as shown by the increase in the grey bars in a given year. Now, what this does in multi-asset portfolios, such as the ones that we have at Netwealth, is smooth that overall path of return. So you've got multiple drivers of return in one portfolio. So even though the UK equity market might be doing poorly, for example, perhaps at the same time bonds are doing well and the emerging market equity position is also doing well. And so the portfolio doesn't drop as much as it would have if it was invested only in one asset class or a few stocks that are overly exposed. So diversification adds that protective layer to portfolios, and this is important. Now, of course, the relationship and the correlations are not perfect between fixed income and equities, as a lot of us may have experienced or known about in 2022 and 2023. You can see there, both equity markets and bonds sold off together as the global economy was grappling with inflation. But having multi-asset portfolios that are well diversified is in our control and can improve investment outcomes, even if it isn't always a perfect correlation. So now I wanted to show quickly the performance of our 7 Netwealth risk levels, so you can see our investment return in practice. So this slide shows performance of our 7 risk levels since our inception in 2016, all the way up to the end of February of this year. So you can see here, the more risk taken, the higher the performance of that portfolio over that long period, but it's also a bumpier path, a more volatile path to get there. Importantly as well, these performance figures are shown net of fees. And if you would like to look at these figures in more detail, we'd be happy to send our full performance pack across. And of course, if you'd like one of our advisors to run a comparison with your current portfolio performance, if you're potentially considering a move, we'd also be very happy to do that. Please do just email advice@Netwealth and we can provide this. And finally, on portfolio performance, I wanted to show you how our risk levels compare to their benchmarks and the peer group. So we have the same information on this slide as shown on the last slide. Risk levels 1 to 7 since inception to the end of February. In the blue bars is the Netwealth portfolios, but we have it against the relevant benchmark in the grey. We benchmark our portfolios against ARC, so that stands for Asset Risk Consultants. They're a third party who amalgamate the performance data of over 100 wealth managers in the UK, so St James's Place, Vanguard, etc. And they create a peer group average for a given level of risk. So we compare risk level 3 with ARC Cautious, risk level 7 with ARC Equity Risk, for example. And obviously, we're very happy to report the outperformance here versus the peer group across those risk levels since inception. And this is in part due to the team's management making the right calls in the market at the right time, which is what you're paying the fee for, but it's also due to the positive tailwind we get from our lower fees and how that compounds up over time to make a big difference in your take-home returns. So what are the fees for our offering? At Netwealth, we have our core service and our advised service, and we levy different fees for that. And you can see here in this table what each provides. Both core and advised clients get the expert investment management, they get financial guidance from our advisory team, access to our tools and events. Where the advised offering differs slightly and why it's more expensive is because these clients get fully regulated advice, bespoke financial plans, and a semi-annual review with a dedicated advisor. So when might that advised offering work better for you than the core? On this slide, we show some of the areas that the one-to-one financial advice with Netwealth can cover in building your unique plan. So income analysis, pension and retirement planning, cash flow modelling, estate planning. And the advised offering can be particularly useful for clients going through significant life events, whether that's reaching their hard-earned retirement, going through a divorce, or getting a promotion, that Netwealth advised offering can provide you with the extra clarity and comfort that you need to navigate this period of your life. Importantly, it's also flexible, so you could start with the core service and then switch to the advised offering if you entered a period of your life where you need more financial planning advice. Or you can even take a one-off piece of financial planning advice whilst on the core offering if this makes more sense for your situation. And so if you are interested in potentially finding out more about the advised offering and financial planning with Netwealth in general, I'd really recommend getting in touch with us and having that initial one-to-one conversation with one of our advisors, where we can understand a bit more about what you're looking to achieve specifically and explain how these different Netwealth offerings may be able to fit into that. So please do email advice@netwealth.com to get that booked in. So what are the charges for those services? You can see in this table here, the fee, whether core or advised, is based on the amount you have invested with us. So our investment minimums are £50,000 unless you're looking to invest as part of a family network that Rachel mentioned earlier. And the more assets you have with us, as is typical in the wealth management industry, that fee reduces. Now, what's important to note is that it's cliff pricing, meaning that if you have £250,000 with us, that entire amount is charged at the 0.6% lower fee rather than just the amount above that threshold. And then the advised offering is 0.35% more expensive than the core due to the bespoke financial planning and advice that you get on that service. So those are our fees. And as I mentioned, that's one of the controllables. So to hammer home this point on the impact of fees and how they can really eat away at your returns, I wanted to show this graph here before we move on to the summary and any questions. So here we have £250,000 either invested with Netwealth in the blue in our core offering, or a traditional wealth manager charging 0.75% more per annum in the grey. Now, 0.75 may sound small and insignificant, but if we control for performance, as we've done in this chart, and instead look only at the differences in fees, so both portfolios there are growing 5% per annum, the only difference in the lines is a 0.75% fee each year. You can see how this compounds up over time rather devastatingly. And after 20 years, fee saving alone, no performance, that equates to £75,000. Now, that fee difference can mean saving up for your house deposit quicker. It can mean having more income at retirement, and that money's better off spent with you and helping you meet your goals than it is being lost in fees. So please do control the controllables, check what you're currently paying for your investments and how this may compare with the Netwealth offering. And if you are struggling to locate that information, as we often unfortunately see providers sometimes being less than transparent on it, then please do getting in contact with Netwealth and we can help you with this and draw a like for like comparison. So to summarize, thanks for joining the session today and Rachel for your useful insights on all things women and wealth. The main takeaways of this session are control the controllables when investing, don't try and time the market, ensure you're diversified, utilize ISAs and pensions and ensure you're paying a competitive fee for that service. And these are all things Netwealth helps clients with on the investment management and financial planning side. So if you are interested in finding out more how it can apply to your specific situation, please do email us at advice@netwealth.com and we can organise a time to speak to run through your specific circumstances and the ways Netwealth can help. I'm joined back now by Rachel, and I believe we did have a good question come through that we've touched on briefly, but maybe we can spend a little bit more time on it now, on tax efficient or tax saving account options at Netwealth, as well as the investment options that may be available at
Netwealth. Yes, thank you, Lily. Yes, tax options. I mean, the thing that people should be thinking about now, because we are less than a month to go until the end of the tax year, is ISA accounts. So an ISA account is a savings vehicle where you can contribute to up to 20,000 a year, and any returns are therefore sheltered from income tax or capital gains tax. Now, that allowance resets every year on the 5th of April. So if you haven't contributed to an ISA this year and you do have money to invest, then it's definitely worth doing that within the next month. And then after tax year end, that resets and you can contribute another 20,000 in the new tax year. There are also junior ISAs for children, where the contribution limits are 9,000 a year. Again, we would probably recommend you save in your own ISA first, but if there is additional money that you want to save for your children, then that's obviously a great way to put it. And also anyone can contribute. So if grandparents want to help save for their grandchildren, then they can also contribute into those JISAs. Pensions as well. Obviously, when you make a contribution into your pension, you may be entitled to tax relief on that. That does vary according to individual circumstances, but that's something that we're also very happy to provide guidance or more formal advice on what contributions you could make into your pension. And yeah, thanks, Lily, very much for talking through the investment options that we offer at Netwealth. Just not much more to add on that, but
Yeah.
just really to say that you can mix and match those. So sometimes we have clients who are saving for different goals. So they might have a portion of money that they're saving for a shorter term goal, and then a portion that they're saving for a longer term goal. So you can have different risk levels within different accounts, and really mix and match those portfolios in order to achieve your own personal financial planning goals. And that's something that we can help talk through with you and kind of help structure for you.
Yeah, I think that's a really interesting point. So a pension that might be more long term and you touch last, or you're young enough that you've got years until you're legally able to touch it anyway, you might be a bit more aggressive with, versus an
Yeah.
ISA that you might be looking at drawing on in the shorter term, that you could then actually have at a completely separate risk level, so invested for completely different goals. And like you said, we can very much help with
Mm.
that. Another question that we had in, more related to women in wealth, which is great, is whether you can transfer mid-career from sort of another financial services sector into wealth management. And I know, Rachel, you've got an interesting career path that perhaps you can touch on now to provide insight in with that question.
Yes, absolutely. And yes, you can, because I did it. So I spent the um, first 14 years of my career at JP Morgan. So I joined JP Morgan after university on their graduate scheme in operations, and spent most of the time working in the investment bank middle office. So what did that mean? I was supporting the traders on the trading floor, worked across both equities and fixed income, dealing with the sort of trading of both things like single stock equities, ETFs, and very complex derivatives at time, through different periods of market turbulence, culminating obviously the financial crisis of 2008. And it wasn't until um, till yeah, really, I guess, yeah, midway through my career so far, that I moved across into wealth management, but which has been a great experience so far, and really interesting to learn that other side of the business. But there are just that knowledge that I gained at JP Morgan has been invaluable, working again in the wealth management sector. And there are loads of transferable skills, lots of transferable knowledge between all sectors in financial services, and I would say you definitely shouldn't feel that you're, by picking one, you're ruling out future moves to
Yeah.
any other areas.
I think general career advice there, whether in wealth management or not, is you're never sort of fully boxed in. You're working for a very long time. If you need to take a sideways move into a different industry, that's how it works. Find out what you love doing and stick around there. So thanks everyone for joining the session. Apologies again at the beginning for the slightly late start. Hopefully you enjoyed the session, and hopefully everybody enjoys International Women's Day this weekend. Bye for now.
Goodbye.